South Africa has more retail space per capita than most emerging markets. With more than 1,400 shopping malls dotted across the country, retail is big business. And in the hunt for growth, many companies have looked to overseas expansion. The Spar Group is one example. Just over a decade ago, the company acquired licenses to operate Spar-branded shops in countries including the UK, Ireland, Switzerland, and Sri Lanka. I met the CEO, Angelo Swartz, at Spar's Durban headquarters. He told me local investment restrictions were part of that motivation.
I think that idea was driven primarily by South African legislation, which limited investment managers from investing too big a part of their portfolio out of South Africa. And therefore, many investment managers were really looking for South African companies to be proxies in other markets.
Spar is largely a wholesale business. In the UK, for example, over 300 independently owned shops all carry the same brand. They benefit from centralized marketing and distribution. In exchange, the Spar Group collects fees and leverages purchasing power with suppliers. But in recent years, its African revenue has far outpaced what it gets from Europe. Take Switzerland, a country with strong trade protection measures. Groceries there are often 50% more expensive than in its European neighbors. When Swartz took over as CEO just 2 years ago, he decided to divest the Swiss and UK businesses, materially strengthening the balance sheet.
When we look at the businesses in the UK and the business in Switzerland, is our view that those businesses are subscale, and the amount of capital that it would have to go into those businesses to get it up to scale to meet our strategic ambitions would be misplaced.
Retail analyst Alec Abraham argues Spar's biggest mistake was taking its eyes off South Africa.
When you go into a new country, there's a very different operating environment, and you need to be focused to understand that market and to succeed in that market.
Back home, Spar is expanding its DIY and pharmacy businesses and is building out its liquor operations.
And I think with Spar being where it is and how competitive the South African market is, we really just want to refocus on our home markets.
That's because liquor shops in South Africa are expanding fast. Last year, they grew almost twice as quickly in the country as conventional supermarkets.
Our liquor brand, Tops, has been around for also about 25 years. And through independent retailers, we've become the single biggest retail liquor brand in this country.
Spar's CEO has branded this battle for shoppers as South Africa's wine wars, a high-margin, high-growth area in an otherwise struggling consumer market.
We have shown that our business has the ability, and our independent retailers have the ability to compete directly with the chains, empowered by us. And we are now the second biggest supermarket brand in this country, which is no mean feat.
Having sparred with what today are smaller supermarket rivals, Swartz may soon be ready to take on #1 ShopRite in what could be his toughest fight yet.